Hi everyone, and welcome to my personal take on the ongoing slow-motion train wreck that is the Euro crisis. Often I will hear commentators on radio and TV arguing over whether the Euro can survive or not. 10 years ago, such doubts were never given credence by the mainstream media. People voicing scepticism of the future of the single currency, such as myself, were only able to express our views on offbeat corners of the internet. How times have changed. But you know what the real point is now? The Euro has already failed. It is already a demonstrable failure. Ask the people of Greece, Spain, Ireland and Italy if they feel the Euro has brought them prosperity. They will assume you're taking the piss. There will be no meaningful improvement in the lives of these people in the peripheral nations all the time they persist in retaining a pseudo-currency that is totally incompatible with the needs of their domestic economies. This brings me back to the main subject of my last bulletin, Portugal. In the mere space of 1 month since my last update, yields on Portuguese bonds have once again risen sharply. So sharply, in fact, that so far as I'm aware, no other Western country has ever seen its borrowing costs rise so fast in such a short space of time. The situation is unprecedented. You may recall in my last podcast I related the story of how Portugal had broken the Wall Street Journal's international bonds yield table by virtue of the fact that Portugal's bond yields had blown the arbitrary 7% limit of the page's bar graphic representation of comparative yields. A few days later, the guys at the Journal had obviously become unhappy with this untidy situation because they introduced a new graphic with a more generous 11% ceiling for all the currencies in the table. Solely for Portugal's benefit, though, since the vast majority of all the other currencies' bonds are yielding on average as little as 2 or 3%. Anyway, the guys at the Journal may have wished that they'd been a little more generous still, since in the 3 weeks since then, a little black dot that represents the costs of Portugal's borrowings has edged further and further towards its new limit. In fact, since I last released an update on the crisis, the yield on 5-year Portuguese paper has risen by a thumping 175 basis points. Portugal's 2-year bonds, in fact, are now trading at a whopping 8% above US Treasuries. The picture is crystal clear. Portugal is rapidly joining Greece and Ireland in finding its debt is being dumped wholesale by the market. Where is China in all this? They promised to support bond purchases of the peripherals, so this kind of thing wouldn't happen. Yet they are nowhere to be seen. All fine words and no action, it's clear. Well, as I've remarked before, they have their own serious problems to deal with. So where does that leave us? The markets have been kind towards the euro over the last 6 weeks or so. The currency is currently 1.427 against the dollar, which is probably more than anyone expected at the beginning of the year. But when Portugal throws in the towel, as it must, since anything over 7% for the country is unaffordable and unsustainable, the euro will inevitably come under selling pressure, because all the old doubts about the currency's long-term credibility will start to surface again. Portugal will be rescued, of course. It's small enough to be covered by the Euro bailout fund. But then that will be 3 countries that have succumbed to this fate through adopting the euro. And the focus will then shift to Spain. And Spain is several orders of magnitude a more serious situation than its Iberian neighbour. It's my belief that Portugal will fall, quite possibly as early as this coming week. It simply cannot go on much longer. If you're an active trader and you are holding any euro-denominated assets such as shares in Euroland companies, I would strongly suggest you look at getting out of these positions as soon as the markets open next week. We could easily see the euro slide to below 130 versus the greenback in a couple of weeks from now. Anyway, till the next time, take care and trade safely.